Karl, thanks very much for agreeing to speak to us today, and we're looking forward to a discussion this evening where we're talking about the ability to raise capital in 2024. So Karl's head of research at Singer Capital Markets and has very kindly agreed to speak at our dinner this evening. So first of all, Karl, how do you see the market for companies considering a fundraise at the moment?
Well, it's not ideal, to be brutally honest. I think that for life sciences and to an extent tech is doing very well at the moment in the US with, the whole AI and the chip dynamics. So that is flowing across to the UK, and we're seeing some interesting sort of interest and sort of investor appetite for some of the tech stocks. On the healthcare life sciences side, unfortunately, that's not the case. We had a very nice rebound at the back end of last year, and sort of post the JP Morgan conference in the US looked very good for the first quarter, and then it's kind of staggered, and that's linked in a major part to inflation, where I think a lot of investors, again talking about the US, but also relates to UK and Europe, we're expecting a series of cuts throughout the year. And in the deck that we'll talk about later, you see that there's an inverse correlation as inflation or as treasury rates go up, so the appetite for biotech comes down. I think the other compounding factors at the moment, while we're in this sort of traffic light, stop, start, go system, or sort of hiatus at the moment, you're also looking ahead again in the US and in the UK for an election. And, in the US, that could be problematic as sort of it filters through to drug pricing, but over here in the UK, my colleague Phil Davies will be at the dinner as well, and there's a certain sense that if the opposition Labour Party do get in, when you look back to sort of Tony Blair, Gordon Brown's time, they acted very quickly, coming in after a long period in opposition. So maybe we'll see the same. But it's a tough environment. Deals can still get done, but it's not the optimum, and it's certainly not as warm a climate as we'd hoped at the start of the year.
Sure. And given that it might take some time for deals to be done and flotations to happen, how far out should a company be thinking in terms of preparing for that event?
Well, there's an interesting array of guests this evening who'll have their views. I think you should always be looking for funding, from the start, because you could do it in a sort of 6 to 9 month time frame. If you hit the button and say go, but really, by the time you get everything lined up, working with your advisors, both sort of on the sort of financial PR, but also the legal and the accountancy, you also have to time it so that your accounts are still fresh. So I would say 2 years. And the bit that I kind of learned when I was not an analyst, but also in corporate land, that really you should be always looking at your financing options and working. Are you looking at an IPO? What about a trade sale, exit? Are there other alternatives? Because you never know what's going to turn up, or so you hit a glitch somewhere along your plan A, and you don't really want to go back to the start. So I would say you're always looking, and certainly when for those interested in the US, I almost did a NASDAQ listing. It was just pulled at the last moment. But even just the prep, I was over in the States every month for 7 months. And that's before we even hit go. So there's a lot of prep. So 2 years will be a good time to start thinking about it.
And as you mentioned, you've had experience on both sides of the fence, both as an advisor and as a CFO.
Poacher and gamekeeper is what you're saying.
Another way of putting it. In your experience, what's the key recipe for having a really successful relationship between CFO and CEO?
Oh, gosh, that's the tricky one, isn't it? I think you have to be the trusted advisor to the CEO. And, one phrase I've often used sort of when I've been sort of interviewed or asked about these roles is that in the nicest possible way, the CFO should be the brake on the CEO's ambitions. Because really, the CEO's there leading the strategy, and you want the CEO, whether he or she, to be really enthusiastic, coming up with fabulous ideas. And really, the CFO's there to say, well, actually, that's a fantastic idea, Richard, but actually, the financing strategy is linked to our equity story, which doesn't include that at the moment. So if we want to include that, and it's never that you're saying no, It's just that you're pointing out where those two items, the equity story and the financial strategy, diverge. But ultimately, you have to be the trusted partner. There needs to be the sort of the trust that you can have disagreements, because you're coming at whatever the question is from different angles, and that's okay. But once you leave the room, and if the CEO says, well, actually, we're going to go right, that's fine. But if it doesn't work out after a certain period, you should be able to go back into that room and say, hey, Bridget, it hasn't worked, can we now go left or whatever? So yeah, it's that trusted partner, but also then linking that corporate or equity story with the financial strategy is really.
And people talk about having an equity story, but what does that mean? And as a CFO or even a CEO, how can that be best used?
Yeah, so the equity story to me, and I'm sure there's going to be a whole host of different views on it. To me, it's linking your corporate strategy in a way that's easily communicated to a wide variety of stakeholders. But at the same time, it is linking back, and whether you're private or public, to your shares, to your value that you want to create, to your equity. So in the public markets, it's creating a story that makes sense to investors. They could see the pot of gold, or you're highlighting the addressable market, but you're linking it back to what are the near-term bite-size value inflection points. Because as the internal team, you might be looking 5-10 years ahead, and there's a tremendous opportunity, particularly like for those therapeutic companies. But that's not going to resonate very well. So you need to sort of take a completely sort of external person and imagine, I'm going to take you through this plan and show you where the value inflection points are, so that if you want to exit at a certain point, there are options or opportunities to do it. So that it's that linking again of that corporate strategy, where you want to go with the financial strategy and value inflection points that are relatively near to midterm, and you can identify those points. And again, as an example, it could be that, you know there's a partnering deal coming, so you're alluding to the timing. Again, it can be dangerous if you don't deliver it, or it could be a readout of some data. And that's why, once companies, whether tech or indeed life science, go public, you need to have that news flow plan to show that you are delivering. And I won't mention the names, but there's a couple of companies at the moment have come in, new management said they are going to deliver X, and it hasn't materialized, and the market has been very unforgiving.
And we've spoken in the past about having almost an internal valuation framework to compare your public valuation, if you like. And there are so many situations that you can't necessarily control as a business itself. But how do you put that in place so that you have almost a sense check on expectation?
Yeah, so from a public company perspective, the market's coming up with a price based on the number of buyers and sellers. So in the start, you need to be making sure that you're communicating the glass is half full all the time and engaging with that audience, particularly shareholders. Now, what has changed, and it keeps going in fits and starts, is the level of retail interest. So you need to open up new channels, and there's a lot of new sort of, albeit almost social media or other platforms that you have to communicate on that. For institutional registers getting on there, you need to make sure that you go and you keep getting that meeting and say, look, this is what I'm going to do, and delivering. And then at the same time, having very good relationships with your analysts, even if they don't have the exact view. And it's never about the value that they come out with in terms of the target price. The market is saying what the market thinks you're worth. But really, when you're talking with analysts, and indeed more generally investors, but particularly with analysts, it's never about the number, it's always about the assumptions. And that's how you take it through. And if someone has a reason or good sort of grounding, say, I'm going to go with this assumption, which lowers price, that's okay. But then you just need to keep engaging with them. So again, it's communicating all the time at every opportunity and being on message, but having that depth of communication that you can go from the elevator pitch down to actually, we need to get into the weeds. And that's where a good CFO comes in. You need someone who's able to, you catch me unawares, you got to deliver the snapshot, but when you're asked about X, Y, Z, your margin or the market you're addressing, be able to sort of nail it.
Great, thank you. And finally, what are your predictions for the rest of 2024?
Well, I'd like to have more hair, which is unlikely. It's a very difficult one. I think, in my current role as an analyst, that analysts tend to be optimistic because they're always looking for a better tomorrow. And certainly, last year was better than the previous, but it wasn't a stellar year for the market in the UK. So I think there's green shoots appearing, but I think Q1 has ended with a little bit of a damp squib, where I was expecting more of a sort of a spring-like sort of burst of life going into the second quarter. We haven't seen that so far. Lots of M&A, there are things to be positive about, and a lot of money on the private side looking for homes. But I think that as the market continues to sort of poodle along, I think that you're going to see increased selectivity on the private side for investment, and on the public, it's going to be tough. For those in tech and life science where the US is so important, the US election is going to be a key driver. But you would expect, whatever that comes, once that settles, the result is settled, you might get a little sort of Christmas or holiday push. But in the UK, again, it'll be that sort of Q4, I think. Otherwise, we're kind of in for not a flat, but a sort of a stop-start. Increased volatility as people don't know where we go. And really the overlying themes that if we can deal with the yields, the rates, and if they come down, then we will see a better market. But at the moment, it's hard to call, because each time we think they're going to be cut, and it hasn't happened. So a relatively positive outlook.
Good, but still difficult to predict.
Always difficult to predict. That's why analysts enjoy their job. One man's sort of positive as another man, or girl's negative.
Yeah. Brilliant. Well, look, thank you very much indeed, Karl, for your insight and for your predictions. We look forward to more this evening.
Excellent. Thanks for the invite. Pleasure.